Welcome to the Financial Frontiers channel, your one-stop destination for all things finance. Today, we delve into a topic that impacts everyone, from the individual to the global economy: inflation. Inflation, in a nutshell, is a general upward trend in prices over time. But it's not just about the price of your favorite chocolate bar going up. It's about the overall decrease in the purchasing power of your hard-earned money. It's a phenomenon that affects every single one of us, regardless of our financial situation. Whether you're a student saving for your first car, a parent planning for your child's education, or a retiree managing your pension, you'll feel the effects of inflation. Imagine you've put aside a sum of money today. In a year's time, due to inflation, that exact sum might not buy you as much as it could today. That's because as prices rise, the value of money falls and its purchasing power diminishes. This is why understanding inflation is crucial, not just for economists or financial analysts, but for everyone. Inflation is an integral part of our global economic system. It's a force that influences interest rates, investment decisions, and government policies. It can stimulate economic growth, but if left unchecked, it can also lead to economic stagnation or even crisis. Inflation is like the wind. We can't see it, but we can certainly feel its effects. It is ever present, subtly shaping our financial landscape. It influences the cost of living, wage negotiations, and even our choices about when to save and when to spend. So why does inflation occur? Well, it can be due to a variety of factors, from an increase in production costs to government policies. But don't worry, we'll dive deeper into the causes and effects of inflation in the upcoming segments. By the end of this video, you will have a solid understanding of what inflation is, why it occurs, and its effects on the economy. So, buckle up as we journey into the world of inflation, a concept that's as fascinating as it is complex. Before we can understand inflation, we need to understand the basics of how economies work. At the heart of any economy is the concept of exchange. No, we're not talking about swapping lunch items in the school cafeteria. We're talking about exchanging goods and services for a common medium known as money. This exchange is driven by two fundamental principles: supply and demand. Let's start with supply. Imagine you're a lemon farmer. The number of lemons you can produce depends on a variety of factors, from the weather to the fertility of your soil. This is your supply. On the other side of the equation is demand. How many people want your lemons? What are they willing to pay for them? This is determined by factors like the popularity of lemonade or the need for lemons in cooking. Now let's bring money into the picture. Money is basically a tool that makes these exchanges easier. Instead of having to barter goods and services directly, you can sell your lemons for money and then use that money to buy other things you need or want. The value of money, like anything else, is influenced by supply and demand. If there's a lot of money in circulation and not much demand for it, the value of money goes down. On the other hand, if there's a high demand for money and not much of it going around, the value of money goes up. This is where inflation comes into play. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. In other words, it's a measure of how much less you can buy with the same amount of money over time. With these fundamentals in mind, we can now begin to explore the concept of inflation. Inflation, as we mentioned earlier, is the rate at which the general level of prices for goods and services is rising. But let's break it down, shall we? When we say general level of prices, what we mean is the average price of a basket of goods and services. Imagine going to a supermarket and picking up a variety of items. Milk, bread, apples, toothpaste, all of these items make up this basket. If you were to do this every year, you'd notice that the cost of your basket is most likely increasing. That's inflation in action. So what about goods and services? Well, goods are tangible items that we can touch and feel. They're the things we buy in stores or online, like a new laptop, a pair of shoes, or a bicycle. Services, on the other hand, are intangible. They're things like a haircut, a ride in a taxi, or a music streaming subscription. Just like goods, the prices of services also rise over time due to inflation. Now, It's important to remember that inflation doesn't mean the price of every single item is increasing. Some prices might go down, others might stay the same, but on average the price level is climbing. That's what we mean by inflation. But why should we care about inflation? Well, inflation affects our purchasing power. If the price of goods and services rise faster than our income, we won't be able to buy as much as we used to. That's why it's so important to understand inflation and how it impacts our daily lives. Inflation is like the temperature of the economy. Just as our bodies need a certain temperature to function properly, so too does the economy need a certain level of inflation. Too much or too little can cause problems. Now that you understand what inflation is, it's time to explore why it happens. Stay tuned as we delve deeper into this fascinating economic phenomenon. There are many causes of inflation, but they all revolve around changes in supply and demand. Let's dive into some of these causes. Firstly, inflation can arise due to increased demand. Think of it as a bidding war. If more people want a limited product or service, they're willing to pay more for it. The competition drives the price up. This is particularly true when the economy is booming and people have more disposable income to spend. Businesses respond by raising their prices, leading to demand pull inflation. Secondly, we have reduced supply. If a business can't produce enough goods or services to meet demand, prices will rise. This can be due to a shortage of raw materials, labor strikes, or natural disasters. When supply doesn't keep up with demand, we call it cost-push inflation. Increased production costs also play a significant role. If the cost of raw materials, labor, or energy goes up, businesses often pass these costs on to consumers in the form of higher prices. This is another form of cost-push inflation. Now, let's talk about built-in inflation. This is inflation that's expected to occur, and it's often linked to adaptive expectations. Workers, for example, might expect their cost of living to increase over the next year, so they negotiate higher wages in advance. Businesses, anticipating higher costs, raise their prices. This creates a self-fulfilling prophecy, where inflation occurs because everyone expects it to. Another cause of inflation is the expansion of money supply. If there's too much money chasing too few goods, prices will rise. This is often the result of policies by central banks. For example, if a central bank lowers interest rates, it encourages borrowing and increases the amount of money in circulation. Similarly, if a government spends more than it earns, it might print more money to cover the deficit. This increases the money supply, leading to inflation. Lastly, we have import prices. If the cost of imported goods rises, it can lead to inflation, especially in economies heavily reliant on imports. This could be due to changes in exchange rates, tariffs, or international commodity prices. These causes often interact in complex ways. For instance, increased demand might lead to higher production costs, which in turn could reduce supply. Similarly, an expansion in money supply might fuel increased demand. It's a dynamic, multifaceted process. It's also worth noting that inflation doesn't occur in a vacuum. It's influenced by a multitude of factors, including government policies, global events, technological advancements, and societal trends. While these are the primary causes, the effects of inflation can be far-reaching. As we'll see in the next section, inflation can have significant impacts on individuals, businesses, and the overall economy. But it's not all doom and gloom. Inflation can also stimulate economic growth and facilitate adjustments in the economy. Stay tuned to find out more. Inflation doesn't just cause prices to rise, it has numerous effects on the economy. Let's delve into the world of inflation and examine its ripple effects. The most immediate and perceptible effect of inflation is reduced purchasing power. As prices rise, each unit of currency buys fewer goods and services. Imagine if a cup of coffee cost $2 last year, but this year, the same cup cost $2.50. You're paying more for the exact same product. That's inflation at work, reducing the purchasing power of your hard-earned money. But inflation doesn't stop there. It also leads to income redistribution. Inflation can affect different groups within society in different ways. For instance, people with fixed incomes, like pensioners, can find themselves at a disadvantage. As prices rise, their income doesn't stretch as far. On the other hand, business owners may see their revenue increase as they raise prices to cover their increasing costs. This can lead to a redistribution of income from people on fixed incomes to those whose earnings can keep pace with inflation. Inflation also creates uncertainty in the economy. When inflation is high or unpredictable, businesses find it more difficult to plan for the future. They can't be sure what their costs will be down the line, which makes it hard to make decisions about investments or hiring. It's like trying to hit a moving target. This uncertainty can hamper economic growth, as businesses may be less willing to take risks or make long-term commitments. But let's not forget about the effects of inflation on savings. In a high inflation environment, the value of savings can erode quickly. If you've stashed away $1,000 for a rainy day and inflation is running at 5% a year, in 20 years, that $1,000 will only have the purchasing power of about $600. So inflation can be a real drain on savings. Inflation can also impact international trade. If a country's inflation rate is higher than that of its trading partners, its goods become more expensive in comparison. This can lead to a decrease in exports and an increase in imports, potentially leading to a trade deficit. Finally, inflation can lead to what economists call menu costs. These are the costs associated with changing prices. Think about a restaurant having to reprint menus every time the price of ingredients goes up. These costs might seem small, but they can add up and become a significant burden for businesses. These effects can be significant, but remember, inflation isn't always negative. It's like a spice in your favorite dish. Too much can ruin the taste, but just the right amount can enhance the flavor. Similarly, a moderate level of inflation can stimulate economic growth. But that's a topic for another scene. For now, keep in mind that understanding the effects of inflation is crucial to navigating the financial landscape. While inflation is often viewed as a negative, it can have positive effects as well. Let's look at both sides of this monetary coin. On the positive side, inflation can provide relief to those in debt. It's a bit like a magic trick. As the value of money decreases, so does the real value of debt. This means that borrowers can repay their obligations with money that's worth less than when they originally borrowed it. Pretty neat, right? Inflation can also encourage spending. When people expect prices to rise in the future, they're more likely to make purchases now rather than later. This increased consumer spending can stimulate economic growth and kickstart a sluggish economy. But let's not forget the other side of the coin. Inflation is not all sunshine and rainbows. It can erode the purchasing power of money. In an inflationary environment, $1 tomorrow is worth less than $1 today. This means that over time, your money can buy less and less. This can be especially tough on those living on fixed incomes like retirees. Moreover, if inflation is too high or unpredictable, it can create uncertainty in the economy. This uncertainty can lead to less investment, as businesses may be reluctant to make long-term plans if they're unsure about future costs. And less investment can hamper economic growth. Finally, inflation can lead to income redistribution. As prices rise, people with fixed incomes or assets that don't keep up with inflation can find themselves worse off, while those with assets that increase in value can benefit. Understanding the positives and negatives of inflation can help you navigate the financial world more effectively. It's like sailing a ship. Knowing the winds, the currents, and the potential storms can help you chart a better course. So keep learning, keep exploring, and keep pushing the boundaries of your financial frontiers. So how do we measure inflation? The answer lies in price indices. To capture the rate at which the overall level of prices for goods and services is changing, economists use a statistical tool called a price index. There are several types of price indices, but we'll focus on two main ones: the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. The CPI is the most commonly used measure of inflation. It measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Think of it as a giant grocery list that includes everything from bread and milk to haircuts and yoga classes to digital downloads and streaming services. Each month, the Bureau of Labor Statistics checks the prices of all the items on this list in various locations all over the country and uses this data to compute the CPI. Now let's talk about the PPI. While the CPI measures the prices that consumers pay, the PPI measures the average change over time in selling prices received by domestic producers for their output. This includes everything from corn to cars. PPI is a crucial tool for economists because it can serve as a leading indicator of consumer price inflation. If producers are paying more for their inputs, they'll likely pass those costs on to consumers. So we've got our CPI and PPI, but how do we use these to measure inflation? Well, we compare the change in these indices over time. If the CPI or PPI increases, that's indicative of inflation. If they decrease, we're looking at deflation. And if they stay the same, we're in a period of price stability. But remember, these indices are just tools. They provide us with a snapshot of economic activity, but they don't tell us why prices are changing or what will happen next. That's where economic analysis comes in. With these tools, economists can track inflation and make predictions about the future. Inflation is a complex and multifaceted topic, but understanding it is crucial in the world of finance. Let's take a moment to revisit the key points we've discussed. We learned that inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. It's a phenomenon that affects every single one of us, whether we're buying a loaf of bread, filling up the car with gas, or saving for our future. We dove deep into the causes of inflation, exploring how factors like increased demand for goods and services or a decrease in the supply of money can lead to this economic situation. We saw how governments and central banks can influence inflation rates, aiming to maintain a delicate balance that promotes growth without causing the economy to overheat. We also examined the effects of inflation, both positive and negative. On one hand, a moderate amount of inflation can stimulate spending and investment, aiding economic growth. On the other hand, high inflation can erode savings and purchasing power, creating uncertainty and potentially leading to economic instability. Then, we looked at how inflation is measured. We discussed the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. These are two of the main tools economists use to track inflation trends and guide policy decisions. But remember, while it's important to understand the mechanics of inflation, it's equally crucial to consider its real-world implications. Inflation impacts our daily lives, our economy, and our financial future. It's not just a theoretical concept, but a real, tangible force that shapes our world. So, as we come to the end of our journey into the world of inflation, let's keep in mind that knowledge is power. The more we understand about inflation, the better equipped we are to navigate the financial landscape and make informed decisions about our money. Remember, understanding inflation equips you with the knowledge to make informed financial decisions. Until next time, stay curious and keep exploring the financial frontiers.